Hey there, everyone. Happy Tuesday and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. It's Tuesday, February 20th. We had the long holiday weekend for President's Day here in the U.S. Reopened trading, and it was not a particularly great day, particularly for some of the leadership names, some of those growth stocks that have really been dominating in 2024, coming off of the October low from last year, really pulling back. NVIDIA down as much as 5+% through the course of the day, ended the day around 4.5% below Friday's close. So a lot of those leading names pulling back just a little bit. Is this the beginning or is this the end of this pullback? I would argue probably early innings of a pullback kind of phase. We have a great guest today, by the way, Jesse Felder. He's been a frequent guest on our show. Always brings some really thoughtful long-term charts. I don't think you'll be disappointed by the charts that he has to share on the show today. And we'll talk a little bit about positioning through this particular environment. With that in mind, let's get to the market recap and see how the environment changed through the course of this Tuesday. Before we get to the charts, had a poll question running over the weekend I want to share with you. Is your equity allocation higher or lower than it was 6 months ago? Simple question. What have you been doing? Adding exposure, reducing exposure, or keeping about the same? About a quarter of you said no real change. About a third of you said you were lowering exposure, which means almost half of you, about 45%, have been increasing exposure. Now, that time frame is an important one, right? 6 months ago, it's sort of interesting, right? When you think about where you're at 6 months ago, that's taking us to what? July, August of last year. That's before a lot of things sort of happened. You know, personally, I'm lower than I was 6 months ago, and I think that's, you know, a lot of that has been at the beginning of this year, kind of changing things given the overextended nature of the market. What's so interesting to me, though, is seeing that result. And again, I know this is not a representative sample. This is a very small, cohort of investors who are avid Final Bar and Stock Charts TV viewers. But having said that, if all of us that have been raising our exposure actually start to change, that's where the correction can kind of really start to manifest itself. What happens when you have names like NVIDIA and SMCI and Meta and all these others that have had incredible runs is at some point people start to get really excited about locking in some of those gains and not just leaving them on the table, but confirming that they've sold at a fairly high level. And the more of that selling happens, the more it tends to beget other selling, because after that initial pullback, then I don't want to miss out on the sell-off, and my selling produces more of a cascade, and that's how corrections can start to go from a very small loss to a very large loss very, very quickly. So this would be a really decent time if you don't have a good money management strategy in mind, trailing stops, key levels, what we call lines in the sand. I would encourage you to be thinking about that immediately and think about where you might want to reduce risk if this sort of pullback becomes much more widespread. A lot of earnings this week, a lot of charts to talk about, so let's get right to the market here. The S&P 500 down about 0.6%. That's from Friday's close. Of course, here in the U.S., we were closed on Monday, so we're back open here on Tuesday. The S&P finished the day just about 49.75, so we did close back below that 5,000 level, which we celebrated here over the last couple weeks. The Nasdaq Composite underperforming, down almost a full percent today, and it was down a little bit more. It sort of rallied in the afternoon, but the damage had been done from earlier in the day, and we were down quite a bit from Friday's close. The Dow actually finished just barely in the red, had a little choppiness there in the last 30 minutes of trading, but still in the negative. Mid caps, small caps, all in the red. So the only thing in the green on page number 1 here is the VIX, and when you have everything red but the green VIX, this is one of those kind of subtle behavioral signals I've picked up, having used stock charts now very regularly since arriving here as the chief market strategist. All red except for green on the VIX is a down day. That's by definition, right? So the VIX up over a full point from Friday's close. We're up above 15, so still mid-teens, still not by any means bearish, but certainly a lot less bullish. We'll look at the chart of the VIX here, time permitting, if we can get to it. Let's keep going with the other asset classes here very quickly. You can see a bit of a mixed bag on interest rates. The long bond yield essentially was the same as it was on Friday, around 4.45. The 10-year point, which is one of the most commonly referred to points, just below 4.3%. We'll call it 4.28. And the 5-year yield almost the same, around 4.25. So the 10 and 5-year points actually came off a little bit. Bond prices in the form of the TLT, similar to the long bond yield, no real change from Friday's close, and the dollar essentially unchanged as well. So sort of a treading water kind of signal from interest rates and from the fixed income markets. A mixed bag here on the commodity space as well. The broader commodity ETF, the DBC, was down about 0.5%. Crude oil prices came off along with natural gas and gasoline prices. Silver and gold mixed as well. Silver was down 1.5%. The GLD, the gold ETF, was up about 0.6%. Finally, cryptocurrencies, pretty choppy sloppy. If you look at the last 24 hours here, it's been kind of all over the place. Bitcoin got up to almost 53,000, down to below 51,000 here just after the close on Tuesday. We're right in the middle. We're splitting it around 52,000. So just below 52,100 for Bitcoin. Ether prices just below 3,000. That's a big round number. We just touched it earlier in the day, came off a bit, and now reapproaching that 3,000 level from below. Other than that, kind of mixed results for cryptocurrencies. Looking at the 11 S&P sectors, a grand total of 1 out of the 11 finished in the green, and that was consumer staples, arguably the most defensive of the 11 S&P sectors, certainly one of the more defensive ones. Names like areas of the consumer staples groups like beverages, like food products, having nice bounces higher. We'll talk about ConAgra Foods, CAG, that is, if we have time during the market recap. But the XLP consumer staples up just over 1%. After that, everything was down. A couple of these were essentially unchanged, right? Utilities basically flat for the day. Communication services, real estate just down slightly. On the bottom, you have technology, consumer discretionary, energy, all down about 1% from yesterday's close. And again, just thinking about the construction of our benchmarks, right? If you look at the S&P 500 and you look at which groups or which sectors have the biggest weightings, it's some of these groups like technology, like consumer discretionary, communication services is certainly one of the larger groups. And so when these big dog sectors are down, the major benchmarks are most likely down as well. And when technology is at the bottom of the list, most likely it is an underperforming day for the Nasdaq 100. What we call the Keller market models, the market trend model I share often on the show, basically still remaining bullish across the board. And this is looking at weekly data. I don't really change it during the week, but as of Friday's close, bullish across the board, short-term, medium-term, long-term. So I think the condition we're at right now with the trends overall quite strong, and this is not including like NVIDIA down 5% today. It's not reflected necessarily on the official reading of these indicators, but all these green arrows basically tell you that the strength in the market, very well documented, very well defined, and clearly still in play. The question is, are we at the end? Are we at the exhaustion point or after the exhaustion point of that uptrend? I would say declining breadth, increases in volatility, pullbacks, and maybe gap filling on some of those leading names like an Amazon certainly could be part of the narrative here through the remainder of February into March. And we're starting to see that quite a bit. Looking here at what I call the Magnificent Seven and Friends. These are 8 stocks, sort of those leading mega cap names. Only one of them, Alphabet, finished in the green today. Pretty much everything else was down. And NVIDIA, which is actually an earnings name this week, down over 4%. Tesla down over 3%, and so on. So some of those biggest gaining names so far year to date really feeling the pain here today. And I think more of that would certainly be a potential cause for concern for the broader benchmarks. Looking at a chart of the S&P 500, so today's close did take us below this trend line. This is a trend line we've been referring to pretty often on the show here in the last month or two. And this is based off of the October low to the mid-January low, the late January low, and where we've been trading here for the last week, kind of chopping around this same trend line. This blue trend line was the one we drew earlier. This is in the fourth quarter we were drawing. This trend line that broke, which told us there was a change of character, ended up being sort of a sideways correction, more of a time correction than a price correction. We settled into this range, 47 to 4,800, and then we broke out of there in January. We continued to make new highs, and that's why I drew another new trend line with this updated slope. And that's actually tracked the price action really well up until today. So today's the first time we're actually closing below that trend line. That is a big time red flag in my book. And again, just like we saw here in December, that doesn't necessarily mean we're going to retrace a big part of the previous gains, but it does tell you that whatever is happening between the low and recent action is now different, right? Something's changing because this trend line is no longer tracking the data very well. Look to see if there's follow through. I think tomorrow's session pretty important to see if we remain below that trend line, if we see additional drops below there. I think that would validate this breakdown we're potentially observing right here. I do want to highlight some of the other data, some of the breadth data in particular here to wrap up our market recap. Looking at the advanced decline lines, it's interesting. The S&P's advanced decline line is actually quite bullish. The mid-cap AD line has actually made a new high for the year here, and so you're starting to see AD lines get above their December peaks, which was pretty important. Now, it's worth noting that the New York Stock Exchange advanced decline line has not done so. The small cap AD line has not done so. So the larger the universe, the more bullish the breadth conditions have been. And I will tell you, this is actually a pretty common phenomenon at major market tops. Not to say that this is necessarily going to be a major market top, but this does rhyme very much with those, where large cap breadth tends to be strong, but all the other breadth tends to be a little to a lot less strong. Now, that looked very exaggerated here in late January when the S&P's AD line was making new highs and none of the other ones were. You're starting to actually see a change there, and I think the mid-cap AD line now already breaking out through the end of last week. But overall, I'd be keeping an eye on the New York Stock Exchange advanced decline line. That's the main one that I like to focus on. Still below the December high. So I think the bull case from here, if you think the markets are going to buck the trend of the seasonal pattern, which is weaker February into March, I think this AD line has to break out. Otherwise, I think highly unlikely we get any sort of meaningful upside beyond what we've seen so far. Now, the McClellan oscillator is one of the basic breadth indicators that we follow. This is not updated for today's close just yet, so this is still as of Friday's close. But given the drop that we had today, I'll be interested to see if we do get the McClellan oscillator dipping below zero. I'm not sure, given the numbers and not knowing the calculations and how that would map into the McClellan oscillator without running some numbers on a calculator. Overall, I would say, question mark. But this remaining above zero is still bullish. This getting below zero, a lot less bullish. It's been all over that zero line here recently, which when I think about indecision, when I think about the fact that the Hindenburg Omen triggered here in the last couple of weeks with that initial sell signal, which we highlighted on the show, this chart is what comes to mind as showing that sort of breadth, which is certainly not bullish at this point, not super bearish, but kind of in a neutral middle ground, sort of a neutral limbo, I guess, for lack of a better term. Now, the bullish percent indexes have gotten a lot less bullish. Here's the bullish percent index today for the Nasdaq 100. As of Friday's close, it was still just above 70%. Today, we're back down around 62%. So now we've completed that rotation out of the bullish range, or I guess the confirmed bullish range, when the bullish percent index is above 70%. It's actually below there, now down, getting near 60%. So I've removed the red shading. That red shading basically indicates we're near the end of the cycle because the bullish percent index is so positive. When it gets back below 70%, that's your warning sign. Now, the S&P's bullish percent index already triggered. We're waiting to see if we would get that confirmed with the Nasdaq's bullish percent index. As of today, I would say that's the case. So today's drop really is continuing some of the negative breadth warnings we've started to see. I would say even more of that we're starting to observe here today. Now, the VIX, today's guest, Jesse Felder, will talk a little bit about volatility and its relationship to the S&P. But I mentioned that the VIX was back above 15. I think that's a concerning, initial sign. The way that I think of the VIX, I would say three parts to this. A VIX above 15 is an initial warning sign. That tells you that probably we're in a pullback phase at least. A VIX above 20 says much higher risk of a much deeper, more significant drawn out, either more time, more price, or a little of both. A VIX above 29 or 2850 is the number I'm highlighting here. Not end of the world, but really bearish. And at that point, it's telling you we're in a confirmed downtrend and volatility very elevated, which is much more consistent with bear market phases than bull market phases. So we've done the initial breakout in volatility, which to me says we're in a pullback phase, at least a pullback phase, right? When some sort of corrective move from a short-term pullback to something much longer. I think VIX above 20 is what starts to differentiate the short-term versus the long-term, right? The buyable pullback versus something that's a little deeper and more destructive. So at this point, VIX above 15, initial warning sign has been registered. Let's look at some other names here just to break down stocks on the move here to finish off our market recap. I want to highlight Walmart, which gapped higher today, over 3% to the upside. It's not a great candle pattern. I wouldn't really call this a shooting star candle because the open and close are pretty far apart. Shooting stars when the open and close are actually very, very close to each other, near the lower end of the range. This is more just a distribution candle, I would say, what I might call a distribution day. So think about what happened, right? We gapped higher from Friday's close around 170.50. We gapped higher and opened around 178. During the day, we traded up to around 181 plus, but today, by the end of the day, we're back at the lower end of the range, around 176. So we gapped open much higher. We traded higher, but then no more buyers, right? No more additional buyers coming in. No more additional optimism suggesting that Walmart's a great deal at elevated prices. You're actually seeing a bunch of selling during the day, and it's finishing more in a position of weakness. And a lot of times, if I'm trying to just get a sense of that, I'll look at an intraday chart. So here's a 5-minute chart on Walmart. So again, you can see we opened here. We traded higher in the first half hour of trading. It's actually kind of, a little bit optimistic after that gap higher. But then that was it. The rest of the day really through lunch, seeing a lot more negativity and no real buyers coming in and pushing price significantly higher. We're actually closed near the lows of the day. So in terms of short-term sentiment, not a great look for Walmart in that we gapped higher and then no one was really excited about owning Walmart over $180, $181 a share. It was more distributive than anything. Apple is a key chart to watch probably in any environment. But when I think about the Magnificent Seven-ish stocks, and I think that labels probably has to change because they're not all magnificent anymore. Tesla, very much an outlier and continuing to pull back today. Apple, certainly one of the least impressive of those leadership names, only because it never really broke out, right? It never broke above the July peak. Here's the July peak just below 200. We retested that in December, retested it again here in mid-January, and every one of those attempts to get above or get toward $200 a share has been repelled, and now we're back at the low end. Today, Apple closing below its 200-day moving average. So I would be looking to see if we can hold this. We're kind of right at that point, right? Apple holding 180 means this is a choppy period. It's not a dramatic uptrend, but it's not horrible, right? It's not an end of the world move by any means because we're still holding support. Apple breaks 180 this week. This is a very different chart because then we have a lower high, then we would have a lower low. This is a chart in a confirmed downtrend. I did a webcast earlier today on RSI. Hopefully some of you were able to join me there for that live webinar, but this is basically the classic sort of downtrend phase type of pattern that we talked about with RSI, a bearish divergence indicating upside exhaustion in December, a retest of those highs, then we rotate lower, and on that retest, the RSI didn't really get above 60, which tells you that really the overall range of the RSI is sort of muted. This is more characteristic of a stock in a pullback or in a downtrend than a stock of an uptrend. So it tells me to be wary of something like Apple. 180 is sort of that trigger. That's where I have the price alert, and I would encourage you to do the same. All right, looking at, that's HS, hold on, HD is what I meant, Home Depot. Home Depot is another one. I mean, talk about a classic RSI divergence, higher highs in price, lower peaks in RSI over, from December through February. Every month we've made a new high on weaker momentum. So that initially does not make me super optimistic. Now, Home Depot's an earnings name today. You can see we opened lower, but actually traded higher. So compare that to a Walmart, which opened higher and closed lower. Here we actually had the opposite. We gapped down, but you had a bunch of buyers coming in here. I think something like Home Depot holding an ascending 50-day moving average is still a pretty constructive chart because we're still making a pattern of higher highs and higher lows. That changes, then I would think we should be concerned. So Home Depot below 350 would get us below the 50-day. I think that would be a dangerous chart, but for now, I think holding up okay. Bath and Body Works. Let's finish on a constructive chart here. It's so interesting with names like NVIDIA pulling back quite a bit today, with a lot of the breadth conditions not getting better, and I would say concerns about market downside. It's just so striking, a name like Bath and Body Works breaking out. This is why I all the time scan for stocks making new 3-month highs and new 3-month lows. It's to surface names like Bath and Body Works actually breaking out here this week, today, up about 4%, while the markets themselves were actually down. One thing I've learned over my career of looking at hundreds of charts a day is that there are names that are working and there are names that are not working in any environment. So I know the whole rising tide lifts all boats, and I think in a lot of ways the market trend can really help you identify the general trend in stocks. But remember, there are going to be opportunities in any environment. I would say it's always a good time to own good charts. So stocks above upward sloping moving averages breaking to new swing highs usually are a good thing. Those are the types of charts I would be looking for opportunity-wise. That's it for our market recap. We're going to have a great guest today, Jesse Felder, joining us in a moment. Before we do so, a couple quick announcements. First off, we'd love to hear from you, particularly questions. I'm on the road next week, but I will be doing some mailbag shows and some live shows or some some daily shows from Dubai. But you're welcome to contact us with your questions. What are you running into as you were trying to analyze these markets using technical analysis, using the stock charts platform, using indicators like RSI? Our email is thefinalbar@stockcharts.com. On X, just tag us in a comment @finalbarsctv. And on our YouTube channel here, just drop a comment below the video you're watching. We would love to hear from you and hope to answer your question in our next mailbag episode. Also want to invite you to participate in a survey. We're going to be wrapping the survey up very soon, but please take some time this week and let us know what you think. We're in the process of evolving Stock Charts TV, thinking about what shows we have, what guests we bring on, what topic areas we're focusing on, and when we're actually programming some of this content. So we'd really appreciate your help in helping us make Stock Charts TV as helpful as possible, as valuable as possible in your daily process. You can scan the QR code on your screen or just click a link in the description here on our YouTube channel to access that survey. It should just take you a couple minutes. We would appreciate it so much. I want to welcome on today's guest, Jesse Felder. Jesse's the founder and editor of the Felder Report, coming to us today from Southern California. Jesse, Happy New Year. Welcome back to the Final Bar. How are you these days?
Doing great. Thanks for having me back on.
No, it's good to talk to you. A lot to talk about. I mean, obviously, the markets had an incredible run the first 6 weeks of the year. Now we're starting to get this sense of discomfort, the sense of uncertainty, I guess. There's a lot of names that have had really good runs starting to retrace just a little bit. Start us off just high level. I mean, where's your head at when you're observing the conditions around you? What's your general takeaways here?
Well, there's been some amazing moves, and it's been, concentrated in a lot of these AI names. One thing I just keep thinking about is one of Bob Farrell's rules, which is, markets that advance in parabolic fashion don't correct by going sideways. Mm-hmm. We've seen this in some of these names, whether it's, super microcomputer or, any of the other names kind of in that space, is that, when they advance in such radical fashion, they usually end up retracing a lot of those gains. It's really kind of retrace those moves. It's kind of reminiscent of the early 2021 moves we saw in some of the meme stocks, GameStop and what have you, where things just exploded higher. A lot of it driven by what's been going on in the options markets with, far, out of the money call options and things. And so, I'm just kind of watching a lot of these things and just thinking, hearing Bob Farrell in the back of my head saying these things won't correct by going sideways.
I love when Bob Farrell's wisdom, this is someone who ran the legendary Merrill technical research team, like back in the 60s, 70s, being able to apply his lessons in 2024 is pretty awesome. Thanks for bringing up his rules there. Let's look at your first chart. This is actually a breadth indicator I don't know if I've ever used, and I'm so glad that you brought it with us. It's called the Titanic Syndrome. Can you talk us through what this indicator is and what it's telling you here?
Sure, and it's really cool that Stock Charts allows you to just kind of pull this up in a chart. It's a signal very similar to the Hindenburg Omen, which I know that you've written about recently, Dave. It's a breadth signal. So I think a Titanic Syndrome is triggered when you have an index, S&P 500, for example, hitting a new, or in this case, actually you have the New York Stock Exchange composite and then a Nasdaq composite on the top of the screen, hitting a new high within a 7-day window, and new lows outnumber new highs on the exchange. So, when you're hitting new highs on an index, you really want to see that very strong breadth. And so when you have a rising number of new lows, it's a sign that maybe under the surface things aren't as strong as they would appear. And so this chart just basically demonstrates when you're seeing a number of these Titanic signals trigger on both the New York Stock Exchange and the Nasdaq over a period of time, it's a pretty effective warning signal that the strength of the trend is potentially waning, and you could be in for a period of more volatility in the months ahead.
It's so interesting. So this is basically the market going higher, but a lot more new lows, which sort of is a juxtaposition of two very different things. We've had this potentially beginning. I mean, Nvidia is kind of gapping down today. They're an earnings name this week. This is after making new significant highs. Do you feel more defensively thinking in a name like this? Is it do you cushion yourself for potential downside? How do you approach a name like an Nvidia that has already had such a run that it's had so far?
Yeah, well, I mean, I have to start off by saying I've been dead wrong on Nvidia. I never thought that this stock could go this far, this fast. But I mean, that's That's the famous saying about bubbles. They go further than you ever thought they
Mm,
imagined, and take longer to resolve.
sure.
I do think that we are in the midst of an AI bubble right now. NVIDIA is one of the leaders of it. 1.8 trillion dollar market cap for this company is pretty astounding. Third most valuable company in the U.S. behind
Right.
only Apple and Microsoft. Yeah, I think, it only trades, almost, under 40 times earnings, forward earnings.
Yeah.
But I think there's, a risk that growth really slows. They're going to see more competition from, AMD and Intel and things. And this is one of those names that's, has just gone up in parabolic fashion on almost any time frame you want to look at.
Yeah.
And so the risk is that it doesn't correct sideways, that it's going to end up retracing a significant amount of its gains once sentiment shifts. And usually that sentiment shift comes in coordination with a disappointment on the growth side.
It's really well said. And then, we start moving down. We're down 4%. All of a sudden, that begets further selling. All of a sudden, there's a cascade of selling, and that's when things can get very ugly very quickly, as I know you've seen before. The second chart you brought with you is really addressing the relationship between the S&P and volatility, looking at the VIX. Can you talk us through this one?
Yeah, so the first chart was really a breadth warning,
Yeah.
that we're seeing a rising number of new lows, which suggests that the participation is not there, for the uptrend that you'd want to see to be really bullish. This is more of a volatility warning signal where we've had a 10-week period now. That indicator on the bottom of the chart just shows the 10-week correlation between the S&P 500 and the VIX. And I created this indicator a number of years ago to look at basically a 10-day correlation when you see stocks go up over a 10-day period and volatility go up. And it's usually a pretty good kind of short-term trading signal that, you could be ripe for a reversal. One of my readers, replied to me, a while back saying this works even better on a 10-week time frame than on a 10-day time frame. And when you look at this and you can see such a positive correlation where you have a 10-week period of significantly rising stock prices and a significantly rising VIX, it's telling you something's not, so the options market is telling you something is, potentially amiss.
Right.
The only times we've seen kind of such a high positive correlation is right before the COVID crash, right before Volmageddon in 2018, and at the 2007 top. And I think I mentioned before we went on the air, if you take this chart back even further, you can also see it in summer of 1998, right before the long-term capital management fiasco, kind of really unfolded. So I'm not a volatility expert, but to me, this suggests that the volatility markets, potentially investors are preparing for a rising volatility environment more than, just the traditional equity market would potentially indicate.
Really, really interesting. You have the VIX kind of in gray in the background so people can see, and it's just a really interesting, very limited number of times when that's happened. It's a really interesting takeaway there. So given that sort of spike in volatility that we're seeing, given the fact that we have the Titanic Syndrome showing some new lows, when you're looking at a chart of the S&P, are you thinking downside potential, and what sort of move are you sort of preparing yourself for here?
Yeah, I think, we are vulnerable retracing in the short term, just from a trading standpoint, a significant part of that move from off of the October low. I think a lot of what's going on right now is this, if we see a break in momentum of these AI names, at the same time, you get the market starting to rethink the idea of rate cuts, that inflation is going to be higher for longer. Maybe interest rates are going to have to be higher for longer. At the same time, you get a break in this AI momentum. You could really kind of, I think, get some selling. People maybe got out over their skis a little too much in terms of taking on risk. And not only that, but positioning has gotten very extreme. I mentioned what's going on in the option markets. We've seen call buying off the charts. But I think if you look at the commitment of traders reports and things, people are about small speculators in S&P 500 futures, money managers in Nasdaq 100 futures are about as long as they've ever been. And so I think there's that crowding that's gone on too. That if you start to see that unwind due to changing sentiment regarding the AI, at the same time as changing, repricing what's going on with monetary policy this year, you could have a shift in that positioning that could create a bigger correction.
It's interesting with some of those names that you've mentioned, like the semiconductor names and others, sort of those leading growth trades. How do you, in this sort of environment, I think a lot of investors are nervous that essentially these things go to zero, right? I mean, they won't literally, but it feels like, you're nervous about sort of losing everything. How do you differentiate sort of a short-term kind of a tradable pullback versus something that's a get out of the way, this is time to get really defensive? Is there a general way that you approach, particularly a name that's had a run, like some of the NVIDIAs and others?
I think for most people, applying some kind of a trend following framework
Yeah.
is that, you can be aggressive as long as price is above the 200-day moving average or, something along those lines. When you get price below the 200-day, and especially price below a declining 200-day moving average, those are the times you need to be defensive. And so I think that, just utilizing some kind of basic trend following framework can be really helpful in terms of that. That if it's good enough for Paul Tudor Jones, right? You ask Paul Tudor Jones how he feels about anything. Is it above or below the 200-day? It's probably good enough for most traders.
Yeah, as much as we love to overcomplicate things, sometimes those simple, easy to follow rules can keep us out of trouble. So given this elevated volatility, given the uncertainty, given the run that we've seen and maybe an initial pullback, how are you finding opportunities in this kind of environment, or where would you be looking to be positioned to try to weather this storm here?
Yeah, I mean, it's a great question. I think there's three sectors of the market that are tied for the most hated asset class on the planet. And that's usually where I like to look. I think the oil and gas stocks, I think oil prices starting to look real interesting to me, that potentially bottoming. And those oil and gas stocks are just so cheap. I mean, they're really the only sector in the stock market right now that trades at a valuation below its long-term average. I think you can look at the gold mining stocks as well, are also very cheap and out of favor. And it's surprising to me with the gold price, holding above $2,000 an ounce, that the miners have been so weak. And then finally, the third thing that I'd point to is, the Chinese equities, especially the, internet-focused names, something like, K-Web, which, focuses on stocks like Alibaba, I mean, are dramatically undervalued relative to their US counterparts. And I think sentiment has gotten so bearish towards China equities right now that pretty much anybody who's wanted to sell these things has had the opportunity over the last year or two, and they've sold. And so you have a very cheap, out of favor market that potentially looks like it's in kind of a bottoming type of pattern.
We only have about a minute left, Jesse, but I'd love to ask you, we're sort of winding through earnings season here. A couple big ones this week in video. We had Home Depot today and some others. You tend to bring some longer term charts with you, but I know you're thinking of different timeframes. How do you sort of think about earnings? How do you prepare for earnings on a Home Depot or others? Is there a general way that you go about it? Do you just think of it as an expected period of volatility, or do you have a general way of kind of navigating through that season on particular names that you're holding?
The earnings, it's impossible to game the earnings reports, right? It's not something I try to do is trade on that time frame. But what I think, I like to look at from a standpoint, I read a lot of earnings transcripts, is, when there is a lot of negative sentiment surrounding a company, and, the questions analysts are asking are all very bearish and they're disappointed. Those are the types of things that I start to get really interested in. And from the flip side, when you have so much, expectations are through the roof for a company, and analysts are just, congratulations and all this, and sentiment is just off the charts. That's the kind of thing where I want to start to become. It's, be fearful when others are greedy, and greedy when others are fearful. Try and the earnings kind of excitement around that helps me understand where we are in that sentiment cycle.
Great contrarian answer there, Jesse. We'll have to leave it there. Awesome to be able to ask you some of these questions, Jesse. Thanks for sharing some charts and some opportunities with us. Be well there. Stay safe. We'll talk to you again soon, all right?
Always great to talk with you, Dave. Thanks.
That's Jesse Felder. Jesse's the founder and editor of the Felder Report. Again, what a pleasure to be able to ask someone like Jesse who's been through a number of different market cycles. Just a good sort of reality check about what you're looking for, where you're finding opportunities. I thought it was very interesting. I love asking people sort of where they're seeing opportunities in any environment. Some of the areas he was highlighting, things like China, gold miners, energy names. These are names that have been underperforming in quite a big way. Is this sort of a alligator jaw kind of move where you had the dominant growth, the underperforming value, and all of a sudden things are starting to mean revert? It's definitely had me thinking. Great take there by Jesse Felder. editor of the Felder report. We got to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. So chart number 1 is Apple. We mentioned in our market recap, Apple, one of the, really diverging from some of the other Magnificent 7 stocks. You have the Metas and Nvidias just breaking to new highs, pulling back a little bit, but overall coming off of new all-time highs. You have some of those Amazon, Netflix type of charts that have already broken out but are now sort of sideways above a price gap. And then you have Tesla and Apple, very much different, all right? These are different charts than the rest of them. And what strikes me on Apple is actually testing price support right now. If you look at the recent swing lows around 180, we're right there. If you look at the 200-day moving average, which has been sloping upwards for the last year, we're right there. And we closed below the 200-day today. And this is after failing to break out above $200 a share just about a month ago. When you think about what happens if and when we break below 180, one of the reasons why this show is called the final bar, because I would always tell people, look at the final bar and then look to the left, right? Look at the current price, look to the left, where are we at relative to where we've been? So if we break below 180, what's next? I'm looking down to this area, so around 169. That combines a couple different things. That would actually be a 38.2% retracement of the way back down from the 23 low, that is, to the peak in July of 2023. 38.2% down is right here around 169. That's basically where we bottomed out in September and October of last year before a retest of the July high. It's also lining up, of course, with price support. So I think that could be a downside objective if and when we would break below 180. That's where I have my alert set. And I would encourage you to use the alert feature liberally on stock charts to make sure that you're aware of names that are breaking down. Question number 2, do we hold some gaps here? And the second chart addresses Disney, Amazon. I posted a video on my YouTube channel called Market Misbehavior on Friday talking about price gaps on some of those names like Amazon and Netflix and others. These are names that gapped higher on earnings mid-January to early February, and now they've stalled out, right? Amazon just hasn't continued with much upside. It's stalled out around 175. It's now back in the middle of this gap. Disney, very different chart leading up to this breakout, but another gap above $100 a share, traded higher up until today when it's down about 2%. So I would say the bear case for stocks here probably involves names like Amazon and Disney at least trading back deep into those price gaps, if not failing to hold price gap support. Stocks tend to hold support in bullish phases. When they are unable to hold support, that tells you there's an evaporation of buyers, and look out below on our major benchmarks. Finally, ConAgra brands, CAG. I mentioned in our market recap, consumer staples, the top performing sector, really the only one in the green today. CAG was one of the leading names, up almost 5% today. Now, CAG is coming off of a pretty low level. Think of this as kind of a double bottoming kind of pattern. We tested that sort of upper 20s support here in October. We ended up bottoming out just above $25 a share on a closing basis, around 26. Here we bottomed out around 26.60, we'll call it, before bouncing higher today. I'd be very keen to see if we can get back and retake some of these levels. $30 a share is where we topped out so far in 2024. Can we get above that level, get above the 200-day moving average? If so, we've got a lot of other overhead resistance here. That's the concern on CAG. But look to see if we're able to get above some of these key resistance levels. And does the momentum improve? That's another key metric I would be looking for on CAG. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close for the Final Bar. A special thank you to Jesse Felder from the Felder Report, joining us from Southern California. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night. Whoa, whoa, whoa.